Hi, my name's Kellie Wood. I'm the Head of Fixed Income here at Schroders, and I am today going to give you an update on the Schroder Fixed Income Fund. This quarter at the start of 25 has been nothing short of chaotic. We have seen a huge amount of uncertainty and volatility that has really started to impact markets on the back of Trump tariffs. And we're now starting to see an environment that looks quite stagflationary being built into equity and bond markets, an environment where growth is weaker and inflation is higher. And some of our modelling suggests if we think about 30% tariffs on China and 25% tariffs on Canada and Mexico, we will see a contraction of US growth of 0.5% minimum and an acceleration of inflation of around 1%. This is a very difficult environment for central banks because it's an environment where growth is slowing, where we'd normally see central banks ease policy, but inflation is quite sticky. So there is a risk here that central banks like the US Federal Reserve will not be able to backstop markets. If we think about the impact this is having to bond yields and credit spreads, we have seen US bond yields move down around 60 basis points since the start of the quarter. Australian bonds have moved sideways, and we've seen the biggest surprise in markets like Europe, the German 10-year bond. And this is because with Trump coming into office, we're now seeing Europe having to spend more money on defence and infrastructure because of the lack of US support. And we've seen German yields rise close to 100 basis points over that first quarter of this year. So there's a lot more volatility in interest rate markets and a lot of opportunity in terms of rotating between Australian and global bonds. Credit markets up until last week have been relatively benign. You can see that in the middle chart in terms of investment grade credit spreads, where US, European and Australian credit spreads have performed exceptionally well over the last 12 to 18 months. Where we have started to see a lot of the volatility around uncertainty on the outlook of the US and the global economy is in high yielding credit spreads, which you can see on the right hand side, where US high yield in the green has widened over 100 basis points over the last 3 months. And this is where we're starting to see the increased risk of recession being priced into equity and credit markets, especially high yielding or lower risk credit markets. If we think back to 2024, this was a very good environment for markets. It was an environment where growth was moderating, not collapsing, and inflation was coming down and central banks were easing policy. It was very supportive of both bond and equity returns. As we move into 2025 and an environment that looks quite stagflationary, where growth is weakening, potentially collapsing with the real risk of US recession, it's a real challenge for riskier markets. And with equities already year to date down 10%, we have seen fixed income deliver positive returns ranging between 1% to 3%. So this is where fixed income becomes a better diversifier of equity risk, where we're expecting very strong returns from Australian government bonds, global government bonds, as well as high quality investment grade credit. If we think about the entry point here in terms of fixed income, we are still seeing very attractive valuations, not only in government bonds, Australian government bonds yielding us around 4.8%, but also in high quality investment grade credit with average ratings of around AA or A, yielding around 5%. We don't believe we're getting compensated for investing in the high yielding asset classes. Asset classes like global high yield may be offering us high yields of 8.5%, but we're already starting to see a weakening global outlook that is actually putting this high yielding asset class under pressure. And then if you look at the equity yields there on the right hand side, the earning yield on Australian equities is 3.5%. I would much rather be owning high quality investment grade corporate bonds or Australian government bonds at yields of around 5% versus equities that are now under a lot of pressure. If we think about what type of returns are likely to unfold this year, with this increase in recession risk in the US, our US recessionary indicator is now sitting at around 40%. So a 40% chance that the US goes into recession over the next year. And this is what the market is starting to price with the volatility we've seen in equity markets and the strong performance from bond markets. And if we think about the Schroder Fixed Income Fund in that recessionary outcome, and here we're looking at our portfolio positions and modelling those portfolio positions with the returns over the next year. And you can see in that recessionary case, when yields are down substantially, 200 odd basis points, and credit spreads are wider, we are seeing double-digit returns. This is where fixed income or duration-based or interest rate fixed income actually starts to do the heavy lifting if we move into an environment where we do see a more severe cyclical downturn. If we think about 2024, that was the time where we saw soft landing being priced into markets. We're moving into an environment that could be quite stagflationary, but very quickly move into recessionary outcomes. And this is where we do want to be owning more duration-based fixed income within our broader multi-asset portfolios. If we think about our scorecard, updated to the end of March, we have started to see a lot more moving parts. In investment grade credit, we still remain positive on Australian and European credit. Shorter duration or shorter maturity, good valuations, much more attractive than US investment grade credit, where we're actually starting to see a lot more weakness. High yielding credit we have been quite negative on coming into the last quarter of last year. We've now started to move our scorecard to more neutral across high yield in US, Europe and Australia. And in securitized credit, we still remain positive on Australian mortgages and securitized mortgages. We have started to moderate some of our exposure to US mortgages as the US consumer comes under a lot more pressure. And in emerging market debt, our preference is to be owning emerging market sovereign bonds, not emerging market corporate bonds. In this environment where we see a weakness in the US dollar, we expect emerging market sovereign bonds to start outperforming. And in terms of our rates risk on the right-hand side of the scorecard, we've started to reduce our interest rate risk in Europe. In that environment where we see higher yields in Europe in terms of fiscal expansion, and we've been adding more exposure into countries like Australia in the US, where we do believe we will see a slowing in growth in those two economies. So we expect Australian and US bonds to be outperforming Europe. If we think about the portfolio now, we have started to shift. And if we look back on 2023 and 2024, we were well set up for a soft landing. And that's where we had a lot more exposure to corporate bonds over government bonds and cash. It was an environment where growth and inflation was supportive of those asset classes and central banks were cutting interest rates. We're now moving into an environment where credit could come under a lot more pressure. And we're starting to rotate our portfolios in favour of cash and government bonds. Even over the last week, we have raised our cash levels up to 15%. We've started to increase our exposure to Australian government bonds, Australian semi-government bonds, and reducing our exposure to credit. And reducing that exposure, we have been reducing US securitized credit as the US consumer comes under pressure. We have been buying protection in global high yield because we believe it's those asset classes that are either linked to the US consumer or have a higher correlation to equities that are most likely to underperform. In terms of our interest rate risks, we have been increasing that exposure over the last quarter. We have been adding more duration to or interest rate risk to both Australia and the US, and we've taken our interest rate risk close to 1 year above our benchmark. getting positioned for the real risk of further volatility in equities that provides this risk-off nature where fixed income can really start to outperform, providing those double-digit returns. In terms of our curve positioning, we're positioned with most of our interest rate risk around the middle of the curve. In this environment where central banks may not be able to ease policy rates if inflation remains sticky, but growth slows, we expect the middle part of the curve to actually outperform. So most of our exposure is in that 5 to 10 year part of the curve. So overall, how are we positioned at the head level for the fixed income fund? The yield to maturity is 5.14%. Versus the benchmark of 4.34. So we're running substantial yield above the benchmark. And that goes back to my earlier chart on the re-establishment of yield in fixed income, because we're moving out of that higher for longer environment to an environment where central banks may have to cut rates to support growth. And the average credit rating of the portfolio is A+. So higher quality. And we're starting to shift that asset allocation where we're reducing our corporate allocation, which is currently around 40%, into governments, which is around 35%. So what we would expect as we move into April is we're increasing that government exposure and reducing our corporate exposure, because we believe in an environment that we should actually start to see government bonds outperforming corporate bonds in a weakening growth environment. We've also started to reduce our securitized exposure, predominantly in the US. We still like Australian securitized or mortgage-backed securities. In this environment where the Australian economy growth has still been holding up and inflation is moderating and the RBA has only just started to commence its easing cycle, we're expecting Australian bonds to outperform global bonds. And that's exactly how we're positioned on the right-hand side, where close to 75% of our portfolio is dominated by Australian bonds over Europe and the US. In terms of performance, this is at the 28th of March. So it's this environment where we should see very strong returns from fixed income portfolios, especially those that are good diversifiers versus equity risk, in terms of having more interest rate exposure within their allocations. In terms of the drivers of excess return, what we have seen over the last year, we've delivered close to 130 basis points over our benchmark. And that has been evenly split between income, rates, and credit.